Hello.
Yes, ma'am.
Why don't you talk? Give me the answer for this one.
So it's MC, no? First one is MC.
Uh, no, here the question is there at the bottom. Estimate the profit maximizing output, price, and the profit. Similar to what we did in the class, no? We did one in the class, this one. And the same question, I put it like this is in the form of a like equation like this, the cost function and the revenue function. So here it's already given the cost and the revenue. So find it a bit difficult to understand this one, then I gave you this example. So that is given straight away, the revenue and cost is given for you to work out the rest, isn't it? This, of course, they've given the cost and the revenue in terms of the output as a function of output. Here it's readily available, so you have to take down last night, last evening. Didn't you do? You want me to do, or I can skip and go to the next section? Tell me. Depends on
Madam,
you.
yeah, will do, madam. With you, madam.
It'll take time. So, yeah, I have to do it in the Excel. You should try and come. Yeah. Can you see the Excel?
Yes, madam.
Okay. So, it is, the question is profit maximizing output, price, profit. Right? So, we know the profit maximizing output. So, we have to basically calculate the profit and see where the maximum profit comes, right? Otherwise, we know the maximum profit is coming at the condition where MR is equal to MC, right? So basically, we'll calculate the MR and MC and see whether when MR equal MC is at the maximum profit without calculating the profit. Okay, so I'll go for the MR. You have to tell me. MR is basically change in the revenue due to change in output, right? So here it's of course 0. This is 1. So 0 becomes 1. So 1 unit additional to revenue 60 unit additional. 60 minus 0. So therefore it is 60, right? And then it's, okay. So the production is increasing from 1 to 2, the next level. And there is a change in the total revenue, right? So we have to see how much the additional revenue we get by additional production. Okay. How much the additional revenue? 160 minus 60.
Madam, can't we put the equation for this?
That is the one I'm saying, no? It's delta TR, right? So it is basically, sorry, equation is, I have to write it like this, no? TR2 minus TR1. Or else, can I put like this? This is the now new revenue for the new level of production. Previous one is this one, right? Change in the revenue, right? So that's B4 minus B3, okay? And that has to change in the output level, because the marginal revenue mean when the output changes by additional 1 unit, right? What is the additional revenue? It's Additional revenue, marginal revenue mean additional revenue, marginal cost mean additional cost, marginal product mean additional product. Resulting, why? Due to change in output. Marginal cost is output changes by 1 unit, so how much the additional cost, right? And the marginal revenue is output changes by changes, so how much the additional revenue for additional 1 unit of output. Marginal product is what is the additional product output due to change in 1 unit of labor, right? So it's marginal product of labor, right? So remember that marginal is always referring to 1 unit, whatever the thing that you're talking about. If you talk about revenue, it is 1 unit change in the revenue or additional revenue due to 1 additional unit, right, of whatever the respective variable. Okay, so here output changes to 2 from 1. Okay, it can be 20, 10 or 20,000, 10,000, whatever it is. Okay, so we need to know for the additional 1 unit, if we are to produce, how much that will contribute to the revenue. Additional revenue resulting additional output. Okay, right. So that is 60. Sorry. If we want, we can go to the next level as well, right? How much the revenue now? Total is 180. Previously, it was 120, right? So this is the additional revenue. Why this is possible additional revenue? Because the production has changed from 3 to 2 to 3. Okay. So it's going to be 60, right? Always. So it is constant, right? So here you can see always the change is here, only 1 unit changes. It's a unit change, right? Constant change. And also 60, 120, 180, 240.
It's all coming 60.
Yes, all coming 60. So I can just simply drag it, right? Means the change in the revenue, total revenue is constant throughout change in the output, right? Change in the output is also 1, so constant, right?
Madam, there now you have to take the subsequent level minus the previous level, like
Previous
no, the
one.
delta
Yeah, that's
change in the sense the next level what has been changed minus the previous
previous one.
revenue.
Yes. Always referring to compared to the previous one, what is the current status? That is the change. Even if you talk about economic growth, what was the economic growth last year compared to last year? How much we have increased the growth, right? So the current one minus previous one. That's always the change, right?
Yes, madam. There may be possibilities of coming negative value also, no, madam.
Exactly. Yeah. Oh, it will
Okay.
be positive or negative depending on this time. If we have this year, if we have gone down in the production,
TR is less,
growth,
it will become minus.
yes. It will become 0 also. There is no change. Okay. So
Like in the first one.
this one.
Yes.
Yeah, this is difference because this is our starting of the production. So starting, there's no production, so no revenue, right? That is a different case. But in between, say for example, this can remain instead of 300, it can remain as 240. So then you'll have 0. See? Okay, then instead of this can become 220. So then you'll have minus. Okay.
Okay, madam. Yeah, okay.
Right. So the given scenario is, it is constant, the total revenue increasing, but the rate of increasing is constant. The rate of increasing is the tangent, that is the marginal revenue, additional revenue. So that is remain constant throughout all possible level of output from 0 to 10, right? So we'll calculate the next one, marginal cost. It is similar way. So additional cost, right? So now how much is the total cost? 149. Right? Previously how much? 100. Why this cost increased or changed? Because of the output change. So what was the output previously? 1. 0. Sorry, now it's 1. Previously 0. Right. It is 49. Right? And go to the next level. Now 149 become 180. Meantime, the production increases from 1 to 2. Right? So how much the additional cost in producing additional 1 unit? That is the marginal cost. 180 minus 149 divided by additional, now 2, earlier 1. Okay, 31, right? What happens to marginal cost? Initially 49, now 31, right? It is starts falling, right? So we'll see the next one. I'm not doing, I'm going to drag it, right? 31s become 19, right? You can see additional, the total cost is increasing, but additional is falling, right? Here 199, 180, 199, 199 to 12. It's still increasing total cost, but what happens to additional cost? 30, right? And next 30, it's constant, right? Again
increasing, no?
increasing. 21, 49, 73, 103. Okay. So this is the minimum is here. So you see that shape, U shape, right? So it's coming down from the higher level 49 become 31, 31 become 19, 19 become 13. And then you can see from 13, there is a constant. And then after it is again rising, right? So the minimum is here, right? Now the question is whether there is any output level where MR is equal to MC. That is the profit maximizing condition is that MR is equal to MC. Can you see any point where MR is equal to MC?
No.
No.
Sorry, any output level in between it's going to be? Yeah. Yes. Come on, marginal revenue is equal to marginal cost.
There's no value equal to that. No.
Yeah, between 8 and 9. Yeah. So between this level and this level, there is a possibility because it's 60, 60. 49, 73, they'll be in between value, no? So definitely.
Between 8 to 9.
Yes, it's going to set somewhere here. 8,000, 9,000 or 80,000, 90,000 or whatever. Right. So.
Madam, we didn't get that, madam. Now maximization come in MR equal MC, no, madam? Then
Yes.
in 7 and 8,
Not 7 and 8.
yeah, MR
8
is
and 9.
8 and 9. MR is 60 for the both case, but
this is simple mathematics.
MC,
49, the next is 73. Say, let's say 8,500. Sorry, yeah, in between. These
In
are like
between value, no? Not
some
really
in
equal, no, madam?
no,
MR.
not. Yeah, like in between it will come equal, no?
Mm.
This is like particular range. Now I said it's like, say, you can't say 8.5. It can be it's like production level. We always say the range, no? 8,000, 9,000, like that, right? So therefore, there can be 8,200. When we produce exactly 8,200, there may be a possibility marginal cost equal to marginal revenue, right? Right. So we from this we can establish it will be somewhere here in between 8 and 9 level of production. And of course, we can calculate the profit. To find out exact profit, what do you do?
Profit total revenue minus total cost.
Yes. So total revenue minus total cost. Right. Initially, of course, there's no revenue. Right. Where is the maximum profit? $156, isn't it?
Yes, madam. 156.
Yeah. So the level, according to this given figures, it is at the production level of 8. 8 level, we can see there is a highest profit, right? Right. So the next question is estimate the maximizing output. That we can say. If you are going based on the MR and MC, you can say it will be somewhere between 8 and the 9th level of production. And it is according to the profit, we can say the highest profit is coming at the 8th level. Yeah. So that you have to say Q equal 8 and profit is 156 and the price is the question. What is the price? How do you find the price? Yeah.
TR divided by Q.
Yeah. TRSP into Q. Sorry, not that is average revenue. Sorry. Okay. Right. Yeah. So price. What did you say? TR divided by Q.
Yeah. Price. Yes, madam. Total revenue divided by quantity output.
Sorry. That is actually average revenue. Yeah. Yeah, it's going to be same, right? Yeah, so it is equal to marginal revenue as well, right? Because marginal revenue is equal to as the price. Yeah, if it is not given, so we first work out the price. So if the price here, according to this, it will be constant. So that price will be definitely equal to marginal revenue, right? Okay, price 60. What is the next one? Calculate all relevant costs, right? So you have marginal cost. We can calculate average cost or average total cost, whatever. So TC is given. So marginal cost we have calculated. So we can calculate the average total cost, right? So total cost divided by Q. Okay. So average total cost, what happens? 149, 90, 66, 53, 45, 41, 39. So the 39 is the minimum, and then it starts
It's again increasing.
So that is also U-shaped now. So therefore, it comes to minimum. We can put minimum, and then marginal cost. How much was the minimum? 13. Yeah. So after the marginal cost only, total cost minimum comes, right? Okay. Then we can calculate what? Average. We can calculate the variable cost, right? How do you calculate the variable cost? Total cost minus fixed cost, isn't it? How much the fixed cost? How much the fixed cost? Yeah.
Fixed cost.
100, right?
Yeah. Because at zero level, there is a production, there is a cost, no production, right? So obviously that is then fixed cost, right? Okay. So then we have to calculate variable cost as total cost minus fixed cost, right? So it's a fixed cost. So throughout it will be fixed.
So it's increasing.
What?
Variable cost is increasing.
Yeah, variable cost is. Yeah, it also will increase for some time. 899, 80, 112, 125, 144.
400.
400, right? So it's the total variable cost. So that is increasing with the output. If we take the average variable cost, total variable cost divided by Q. Okay. Total variable cost divided by Q. 2 unit producing 80. Next, 99 is for producing 3 units. Okay. Right. So this will like come down variable cost.
Decreasing, then increase.
Yeah, decreasing, come to minimum 25, 24, 25. Right? You should note that here the total variable cost, average total cost is 39. That is at output level 7. And definitely average variable cost minimum should be before that level. That you have to always check. Right? And so it won't come here even. Before that, it will come, it takes the minimum. Okay. 28, it's increasing thereafter. 33. Okay. So marginal cost is the first minimum, then the average variable cost is the first minimum, second minimum, and the third minimum is average total cost, right? Because this cost is always less than this cost, and this cost is less than this cost. Okay, right. So if you want, you can calculate the average fixed cost also. That is fixed cost divided by Q. Fixed cost 100 for 1 unit. Then fixed cost again 100 for 2 unit. The fixed is now distributed among higher level of production, right? So it is increasing, decreasing, right? So always average fixed cost is decreasing. Okay, 150 this, right? Okay, so average fixed cost is there, average variable cost is there. So you can add these two and you can check with this. Average total cost is addition of average fixed cost plus average variable cost, right? 50 plus 40, 90, 33.3, 33, 66, 25, 28, 53, right? Okay. So these are the all cost. Okay.
Average variable cost in Q3, it should come decimal, like, madam. When you take Q3 level,
It's okay. That is just we have
Yeah,
actual
average
total
variable,
cost,
total variable
actual
cost is
total.
99, no?
That is okay, madam. Actual total cost of Q3,
Yeah.
TC divided by Q, no, madam. TC is 199. 199 divided by 3 should come decimal 66 something.
Yeah, it's coming now. No? 199 divided by
3.
3.
66.66.
66. How did I calculate this one?
so you can
Yes,
change
yes.
that decimal, madam. So if you want to
Yeah.
accept, just if need, we can adjust that 2 decimal or 3 decimal, whatever.
Yeah. These are anyway whole number, I think. Only this. Yeah. Okay.
Okay.
Okay. Right. So all relevant cost. Yeah. This one also you didn't do, no? Right. So Macron is an engineering company as identified following input-output combinations are suitable for its production line based on the expert's experience. If the wage rate is 10,000 per week and the rental price is, of capital is 20,000 per week, then the cost minimizing combination labor and capital for various rates of production measured in thousands of tons per month are as follows, right? Yeah, sorry. Okay, calculate the long run total cost, average cost, marginal cost. Also calculate short run total fixed cost, total variable cost, average variable cost, and the assumption that the capital is fixed and complete the table by entering the values in thousand, plot the LPCs. Okay. Right. So Q 10, 20, 40, 60 like that. K also changing. L also changing. Right. So this is LTC. Long run total cost. Right. So we can calculate that LTC. Long run mean what? Long run means all inputs are changing. Okay. Short run mean capital is fixed. Right. Yeah. So it is the fixed cost plus variable cost, or sorry, labor cost plus capital cost. We won't talk about variable cost, fixed cost in the long run. So it's only the short run where we have two components, variable cost and the fixed cost, right? When you talk about cost in long run, it's just the capital cost and the labor cost. Okay, right. So you have to put this one. L K also Q we have to put. Q is for 10, 20, 40, 60, 100. Okay. And the L 6, 10, 20, 24, 35. Sorry, capital is 3, 6,
10, 18,
10, 18, 45. Okay. Right. So it's given 10,000 plus 20,000 rent.
It's per week, no?
Yes, it's per week. Yeah, so that is, we don't have to multiply by 4 because it is usually they give that weekly rent, no?
Yes, weekly rent.
Yeah, so, but this quantity is for monthly, right? This.
Then we have to add the factor 4, no?
No, because it's individual. If you take some quantity will be there for measured in thousands of tons per month as follows, right? Say for example, so we are producing 10,000 units monthly, okay? And for that, we get 6 units monthly, maybe weekly 2 something, isn't it?
Then no.
Then no need, no. Okay? Correct, no?
Yes, madam.
Okay. So labor charge is 10,000 plus, this is the labor cost plus capital cost. 3 into 20,000.
Madam, better
Yeah.
you can put that 3 instead of 3, so you can put the K, that value. So you have to put that column.
Yeah.
Yes, K7.
This one, no?
Yeah.
Yeah. Okay, thank you. Yeah, so this is the long run total cost. Okay. Next is TFC. Total fixed cost. total variable cost, long run average cost, long run marginal cost.
Madam,
Yeah.
can you put the LTC equation there in simple way? So
That is, say long run. How do I put like for the R labor L into price of the labor. Shall I put LP? LP, I'll put subscript. It's given, I guess. There is a notation was given in the W and the R.
So rental is R, no?
Yes, rental is R.
W is a wage.
L into W plus K into R. Yeah. Okay, no? L into 10,000 plus K into R 20,000. Okay. Okay, so we can calculate everything for the long run. So long run, it's not appropriate to say it TFC TVC because we won't talk fixed cost, variable cost in the long run, right? So since it is this one, this TFC is for actually short run. TVC is for variable cost short run, okay? And AVC is average variable cost. LAC is, yes, we can do LAC, that's for the long run. Okay, so that is total cost divided by this Q. So LTC divided by Q. Okay, right? LAC, okay. LMC. LMC is what? Long run marginal cost. How do we get the marginal cost? Is delta. Just write change. Otherwise, I have to find that delta sign here. Change in LTC divided by change in Q. Okay. So change in LTC. LTC 220. 120 become 220. Divide by 20. 10 become 20. Okay. And I'll do the next one as well. 400. 220 become 400. Divide by 40 become, 20 become 40. Okay. Right. LTC, LMC, LTC, LAC, LMC. Okay. This is all for the long run. Okay. Oh. Okay. Okay, so this is the long run situation. So then for the short run, you can separately work out, right? So I'll take the same thing. Right. So short run, capital constant, right? So therefore, we have to assume that whatever we had at the initial, 3, remain 3. Okay. There is nothing given about it, isn't it? So calculate the long run total cost, average cost, marginal cost for LMC, right? Also calculate the short run total fixed cost, right? Short run total fixed cost. Yeah, capital is output level increasing for the long run 20, 40, 60 and so on, right? Yeah, total variable, total fixed cost. Yes, it is, we have to assume as 3. Sorry, 3 is the unit. It is 3 into 20. There is assumption as capital is fixed. What is that? Yes, we have to assume like that because capital remains same, no? So 3. So 3. So we calculate actually the total fixed cost. Okay.
So K we consider as a fixed cost, no?
Yeah, that is capital. No? So then it is 3 into 20,000. Is it? Or is 60? Okay. It's 60,000. Okay, that is the fixed cost. And then we can calculate the variable cost. It is 6 into 10,000. Labor. Okay. Then we calculate the total cost. Fixed cost plus variable cost. And then we can calculate the average short run average total cost. Total cost is this, divide by Q. Okay. What is the question? Yeah, average variable cost, total variable cost, average variable. So assumption the capital is fixed. Yeah, sorry. Yeah, it's given. Capital is fixed and complete this. Capital is fixed. Yeah. So plot LTC, LAC, LMC on the graphs that follow. Yeah. So we have to plot these 3. LTC, sorry, LAC and LMC with the Q. LTC no use, no, LTC would increase. So LTC is increasing, so that's not this one. LAC, we can see 12,000, 11,000. Yeah, there is this L, both minimum. You can see here 10,000, 10,000. So it is constant. Here the cost is reducing, and then here the cost is increasing. So this is decreasing return to scale, and this is constant return to scale, and this is increasing returns to scale, right? So, and this you can see LMC is intersecting this second 10,000, that is at the 60, right? So if you remember the graph that we had yesterday, long run cost curve, you see here also 10,000, here also 10,000, right? And the marginal cost LMC is going through this, right? I showed you yesterday some other graphs. Here, can you see the LMC? Long run marginal cost. It is intersecting through, this is the LRAC, right? And LRAC intersecting here, and QM is actually, QM is now, sorry, in the Excel. No? In the Excel, so it is at output level 60, you can see long run average cost and the long run marginal cost are same. Okay, right. So that is the question. Yeah, plot TL, TCL, ACA on the graph. Describe return to scale for this production function, right? So that is what I told you now. So this range, these two we can put as increasing return. Why? Why scale is increasing? Production is become from 10,000 to 20,000. Meantime, you can see the long run average cost is coming down from per unit cost is 12,000 to 11,000, right? So therefore, it is increasing return to scale. And then these two, 10,000, 10,000. So we can merge those two, and it is constant return to scale. Okay. And in the last one, the 10,000 is picking up as 12,500. So you can see it is decreasing return to scale. Okay. All right. Cool.
Madam, yeah, madam. Now, since you have done all the Excel, now two
Mhm.
values, when you are going to draw the graph, if you make use of that column for, Q and LTC, ATC, everything, you can just draw it, no, madam?
I
Insert.
do. It'll take time.
Okay.
No?
Right.
Yeah, it'll take time actually. So can I have to the graph insert? It has to be a line graph. change chart data. This is for the vertical axis. Now, for vertical axis, we put both cost, isn't it? And one series one is what? The pattern also need to go for a different. Otherwise, I have to take this out. No, that is also. Oh, yeah. Yeah, LMC and LTC, no, LAC, yeah, this is the one. Still I don't know, the graph will take time. To change it, isn't it? We will have to change the data. For this one, yeah, it is horizontal axis is this one. Yes, and from the Q, we have to remove the Q here. Should be okay. Okay. Yeah, so you can see roughly it takes, because we have only 5 points now. So it takes the shape like this, LAC. Can you see? And this is the constant, isn't it? And the long run average cost is cutting this one. Sorry, long run marginal cost is. Okay. Harida.
Okay. Hari, madam. Okay, thank you.
Roughly make a shape. You can see, this is coming down and these two are constant and this is going up. Okay, you can touch here 10,000. 10,000. This is 12,000. This should be 12,500. Right. Okay. Right. I put some more question. It's already 11:30. 1 hour gone. You should have tried. Okay. Do this one quickly then. Just do. Quickly do and give me the answer. So like if 1 or 2 get the answer, we can move to the next one. Are you doing? You all have the Excel now? Isn't it? Computer? Most of you are on the phone, right? අයියෝ මේ ළමයි කට අරින්නව නෑනේ.
Yes, madam. Phone. Phone.
ෆෝන් ඉත ගෙදර වැඩ, ඔෆිස් එක වැඩ. Where is the economic crisis? ඕන තරම් වැඩ තියෙනවානේ.
Yes.
So normally economic downturn එකේ වැඩ නැහැ කියලා තමයි කියන්නේ. Recession. So now we are experiencing the worst of the recession, which is depression, crisis. Right? Office එකේ වැඩ තියෙනවා, ගෙදරත් වැඩ තියෙනවානේ.
Madam, for that TC, we have to use the first the equation, no?
Sorry?
For the
TC
we
is this first equation. Yeah.
Okay.
appreciate if you can share us the Excel. Just need to try and see. Like Excel like that. Um, $23. Sorry, sorry. The people are doing this. සද්ද නැතුව ඉන්නවනේ කරන්න ඕනේ නෑනේ කියලා. Screen sharing එක stop වුණාම what is that? What is the file working managing accounts? Can you see you got the file? Excel file? Hello? Hello?
We can see under the example given PowerPoint slide, madam.
No, Excel, I put it in the chat. Somebody requested. Chat take a file it down. Right. Okay. Have you done? Determine the
No, but
equation.
not received, madam. Not received. The chat box.
No?
No, madam. Maybe you
Somebody
have
has.
sent to maybe the requested person.
Okay. Right. It has gone to her. Her or him, I don't. Okay. Right. So, did you get this one? This is just to recall, like, whether you understand, right? So, TVC. What is TVC component here? Tell me, like, how long I can't
Yeah, the
explain
TC
that.
is a total cost.
Yes. TVC equation from this one, tell me.
Except the 1350 partner.
Yes, correct. TFC?
Uh, 1350.
Okay. Next one is average fixed cost. Okay. F name, P name, F. Right. Average fixed cost. Right. Yeah, 1350 divided by Q, ne? Average fixed cost. Total fixed cost 1350 naman. එකෙන් Q වලින් බෙදන්නේ තියෙන්නේ. Right. Tell me average variable cost. Just to check whether you got the concept correctly. That's it.
TVC divided by Q.
Variable
TVC.
cost divided by Q.
Yes, TVC divided by total variable cost divided by Q. That means 75Q divided by Q. 75 minus 16Q plus Q square, right? Okay. Okay, correct. Next one, average variable cost. That's that one. Average total cost.
Average variable cost plus average fixed cost.
Yes. Either from the TC function, divide everything by Q, right? Where TC 1350, 75Q minus 16Q square plus Q divide by Q, right? Marginal
Yes.
cost. Okay, marginal cost. Quick.
Delta TC divided by delta Q.
Yes. That is mathematically derivative of total cost divided by, derivative of total cost with respect to Q, right? So DTC divided by DQ or DTC by DQ, right? So 1350 differentiate with respect to Q, 0. 75Q differentiate with respect to Q, 75. Minus 16Q squared differentiate with respect to Q, that is 32Q. 16 into Q squared is 2Q. So 32Q plus Q3 differentiate with respect to Q, 3Q squared. Okay. I can write if you want marginal cost only here. Other ones you can do. It's like derivative of total cost, with respect to Q.
DQ.
DQ, yes. And that is, so 1050 into 0 plus 75 into 1 minus 16 into 2Q plus 3Q squared. Okay. Q to the power 2. Okay. All right. Okay.
That is 16 2Q is coming 16 into Q to the power 2. No?
Q to the power 2, when you differentiate with respect to Q, it's 2Q, right?
Yeah.
So it's 32Q.
Oh.
So you can simplify. That is 75 minus 32Q plus 3Q squared. Right. So this is the marginal cost equation. Right. So the price of its product that firm faces rupees 30, and it is an independent from amount sold. The firm total cost function is, yeah, so that is a different question. Yeah. Total cost function is again given. Determine the best level of output. What is that? What do you mean by best level of output? So various Q, we can produce 10, 20, 30, and so on. What is the best output level? How do we decide that? Come on.
Maximum output level.
Yeah, that is the best output level. What does it mean?
Where MC is equal to
So profit
TC.
is max.
Yeah, two people clashed. Yeah. Say one said about cost, other one said about profit. Okay, say. Yeah, somebody says MC equal MR. Now, yes, that is also we can go for, because
The MC equal to MR means the maximum profit norm.
yes. Yeah, both way it should be okay, because the information given, the price of its product that firm faces is 30. P is 30. It is given, it is an independent from the amount sold, right? So means any output, it will be sold at 30 rupees, right? So the price is anyway then constant. Okay. So in that case, if the price is constant, we know that MR is equal to P, right? MR is equal to delta TR over delta Q, and delta TR is P into Q. P is constant, so therefore delta Q divided by delta Q. So MR is equal to P, right? So you know MR is equal to 30. Now we have to find the MC, isn't it? Okay, so from this find the MC and equate that for 30 and get the Q. And somebody else was trying to say something about in terms of the cost. Right, do it. ළමයි fast වෙනද කොච්චර තියෙනවද ඔයගොල්ලන්ට syllabus cover කරන්න. This is which session? How many sessions we have covered? මෙච්චර slow and බැහැ. This is fourth session or fifth session? අයියෝ මේ ළමයිත් එක්ක බෑනේ, මේ ළමයි කතා කරන්නම නෑ. Hello? අයියෝ මේ ළමයිත් එක්ක. next year එක නම් බෑ කියනවා සර්ට, මේ ළමයිත් එක්ක බෑ කියන. ඔය MSc ළම undergraduates වඩා worse නේ. මම එක්කෝ කරන්න පුළුවන් කරන්න ඕනේ, කරන්න දන්නේ නැත්නම් දන්නේ නැහැ කියන්න ඕනේ, කරන්න කියන්න ඕනේ. මොකද කියන්නේ? ඔය කෙනෙක් දෙන්නේ උත්තර දෙන්න. Fifth one. What is the fifth one? What do you mean by fifth one? Oh, session. Sorry. I'm very sorry. Okay, this is the fifth one. So we have 5 more sessions there. How many sections are there? Market structure is there. Utility. Demand forecasting is there. Game theory. There are a lot of areas there. So I don't know how to. Right. Did you calculate the Q? Can you calculate? ළමයි කතා කරන්නේ නැද්ද? කරන්න නැති වුණාම කරන්න කොහොමද අපි? Right. So MR change in TR divided by change in Q. So price constant. I put delta. I write it like P into Q divided by delta Q. So that's equal to P. So P MR equal 30. MC is equal to DTC. Divided by DQ. So MC equal 1/3 into Q cube. So 3Q squared. So 1/3 3 cancel out. So it's Q squared minus 8.5 Q2. So means 8.5 into 2, 17 Q plus
60.
60.
Plus 6. Plus 6.
Six.
Yeah. 60.
60 now? Yeah.
60, yes.
Yeah. So MR is equal to MC for best output. That is called profit maximizing output. MR is equal to MC. So Q squared minus 17Q plus 60 equal 30. So 30. 60 minus 30, 30. So it's Q squared minus 17Q plus 30 equals 0. So how much the Q? Yeah, 15 minus 15Q minus 2Q plus 2Q, right? So 2Q equal to 30. So that's Q squared minus 15Q. So Q minus 15. It is Q minus 15 it's mathematical into Q plus 2 the Q plus 2 neither.
Yes,
Oh.
ma'am. We are getting two answers. One is 15, one is 2. Yeah.
One is minus 2.
Yeah.
Yeah. So Q equal 50. Yeah. That is one way. right? Otherwise, what we can do is actually optimum output is we target the average cost minimum, right? So AC minimum equals 0. That also we can check. We go up to the point where average cost is minimum, okay? And average cost minimum is so average cost minimum should be equal to 0. Okay, you see that graph, average cost, the tangent, it is tangent, so that the ATC, the slope of that is 0, right? So total cost is given, so we can see DTC by average cost. What is the average cost? It is TC divided by Q, isn't it? TC divided by Q. So it is 1/3 Q squared minus 8.5 Q plus 60 plus 27 divided by Q, isn't it? This is the average cost. And so we can say D average cost DQ equal 2/3 Q minus 8.5 Q. This has become complicated. 8.5 Q. No, Q and 8.5. Yes. Then next one is 0. So that is minus 27 Q to the power minus 1. So minus 1 minus 2. So 27 divided by Q squared, isn't it? It is difficult. Again, we go to the same is to solve. Sorry. That is equal to 0. From that, we can take the Q. That is one way. Okay. So minimum average cost should be 0, right? So that how do we get that minimum average cost is at that the slope is DTC by DQ. So that is 0. Okay. Right. Again, I think we'll go to the same equation. Yeah. Okay. Right. Determine the best level of output. Calculate the total profit of the firm at this best level of output. Total profit. Yes. Total profit we can get TR minus TC. Okay. So TR for Q equal 50 equal P15 and Q15, isn't it? TQ for Q equal 15. That is, TC. So in this equation, you have to supply Q equal 50. Okay, so you'll get the TC. So TR is there already. Q equal 2 as well. Where? From this one? Minus 15Q plus Q equal 2 as well. No? Oh, this is actually minus 15Q plus minus 2Q is the minus 17Q. Minus 15 into minus 2 plus 30 here. So if we distribute, it is Q square minus 15Q minus 2Q, no? 17Q plus 30. Okay, so if you take the Q out, Q minus 15. Here, if you take minus Q out, Q minus 15, yes. Yes. Okay, Q minus 2, ne? Yes, correct. Yes. Okay, Q equal 15. Oh. Yeah, obviously, in that case, we can still exclude the 2 because it's the highest level of output is Q. 2 is 15 is higher level of output, no? So we can avoid 2. So best output is 15 because we have to complete MR is equal to MC. So I said it can happen both sides, isn't it? So what happens is your MR curve is going to be like this, right? Whereas, sorry, MC curve is going to be U-shape, right? And MR is going to cut that across. It's a horizontal line because MR is constant, no? So it is at the 30. So it's going to be like this. So therefore, basically, it's going to cut the MC curve at 2 points, right? One is actually 2, Q equal 2. Other one is Q equal 50, right? So obviously, Q equal 2 is less output, right? And you remember the MR is equal to MC. There are two conditions. One is MC equal MR. That is a first order condition. The second order condition is that should be met during the rising level of output, right? So here, this is the rising level of the MC. So this side, if you take, MC is going down. So therefore, we can't take Q equal 2. So like that, you have to say it's Q equal 2 is not the best level of output, right? Even though it satisfies the first condition, it doesn't satisfy the second condition, right? Okay, thanks. I thought it's a plus 2. Okay. Right. So that's one way. So we can calculate and determine the shutdown price. How do we get the shutdown price? As I said yesterday, I told you in one of the slides, right? Profit, the types of profit we discuss, isn't it? Here, subnormal profit is the profit below the normal profit. Firms may not exit the market even if the subnormal profits made, if they're able to cover the variable cost, right? So in the short run, firm will continue producing whilst making subnormal profit as long as their average variable cost is covered. Okay. So therefore, we have to now calculate the average variable cost and see average variable cost is per unit variable cost, right? So you can compare that with the price and see whether average variable cost is greater than P. So means 1 unit cost is covered by the price. Price is for 1 unit, no? So 30 rupees is given for as the price. So now you have to calculate the average variable cost and see whether the average variable cost is higher than price. If it is higher than the price, we can't survive. Price should be enough to cover the average variable cost, at least. Then only even if we make subnormal profit, we can survive. right? So the question is shutting down price. Okay, shutdown price means average variable cost should be equal to price, right? So it should be less than or equal to price. At least the price should be equal for that. So in this equation, we know this is the variable cost, isn't it? So when you divide this by the Q, you will get the AVC, right? And equate that AVC for P. Sorry, what do you call? Yeah, price. Price is 30 now, right? So when you put that for 30, sorry, the question is shutdown price of the firm. Yeah, shutdown price is, condition is AVC less than or equal to price, right? So the minimum average variable cost, right? That is actually, they are asking the price, average variable cost. So, yeah, so that is equal to price. So we can get the Q. And when we get the Q, what do we get for the price? Of, yeah, shutdown price. Yeah, that's, we can say actually, like if you see the average variable cost, the minimum of average variable cost and the price. So they should touch, right? So therefore, P equal minimum AVC, right? So minimum AVC is the slope of that is equal to 0. Okay. So in this case, this is our variable cost, isn't it? So if you take this one here, you can say average, sorry, yeah, first average cost. No, we say variable cost, sorry. Variable cost, we remove this 27, isn't it? That is the variable cost. Then we get the average variable cost. Okay. That is 1/3 into Q squared, isn't it?
Yes, ma'am.
Okay. Then 8.5 Q squared. So it's Q. Okay. Plus 60. Okay. This is the average variable cost, right? And so if you take that, so the minimum of that is, that should be equal to price. Okay. So what is the minimum of AVC? When the minimum AVC will be minimum, what happens is the condition minimum AVC means the slope is 0, isn't it? So, sorry, subscript. Minimum AVC is reached, delta AVC. differentiate with respect to Q. That's equal to 0. Okay. So in this case, we check this and that equal to 0. So we find the Q there. And then when we supply the Q for this equation, we will get the AVC. That AVC is the price. Okay. Because at the shutdown price equal minimum AVC. Okay, because AVC, if our price is below the minimum AVC, right, we can't survive, right? At least it should be enough to cover the minimum AVC, right? So therefore, if the price comes down below that, it will be shutting down, right? So the shutdown price is minimum AVC. Okay. Now AVC minimum is, we can get it from this as, I'll put here, that 1/3 Q squared, when we say it is 1/3 Q minus 8.5. Okay. Equal 0. Okay. So Q equal,
Ma'am, it's actually 2/3Q, right?
no, when you derivate, it's Q squared become, sorry, 2Q. Yes, 2. Yeah. Yeah. So, sorry. Yes. That is, yeah, 2, let's say 1 into 2Q. Yeah. Then it is 2/3Q. So Q equal 3 into 8.5 divided by 2, isn't it?
Yeah.
How much will that be?
12.75.
So Q equal 12.75. Okay. So here we put, so for the condition for the AVC minimum, Q equal 12.5. So when you put Q equal 12.5 in this equation, can you find AVC? Let's come to bracket Q equal 12.75. You should, you can check here. AC minimum is Q15. So before that, AVC should reach the minimum. So definitely the answer should be less than 50. Right? Can somebody is getting the answer now? So then price is equal minimum ABC. Okay. Shutdown price is minimum ABC. Okay. So I hope you will handle that question. Okay. So that's the way we decide the shutdown price. Okay. Right. Next, what is this one? Given the below are the cost of constructing houses of a housing developer. Total cost is given. Selling price is 750,000. What is the output level? Profit is maximum. Yeah. So basically TC is there. TC is there. So calculate the TR, no? Isn't it? Huh? Okay or no? Are you all okay? Huh? ඒකෝඩ් වෙලාමයි ඒ කට්ටලි නැද්දේ? Huh? Hello. Hello. God. Hadi.
Actually, this is 100,000.
Which one?
Madam, that the total cost is
Yeah. 100,000. Yeah, you can see up there, no? It is in thousands. Okay. So selling price is given. So it's like any output per house is sold at 750,000. Okay, now you can manage, right? Yes or no? අයියෝ ළමයි එක්ක මොනවද කරන්නේ? Huh? Hello? මේ ළමයි කතා කරන්නට. ඔගොල්ලෝ අනිත් subjects වලට කොහොමද ඉන්නේ? Huh? Hello? යප්පා. කතා කරන්නම නෑනේ. එහෙම බැච් එක මම කළම නෑ. Huh? කුමාර ඉන්නවද? Huh? රත්නායක? ඕකේද? ෂෝමි ළමයි.
Yes, madam. Okay.
Okay. ෂෝමි ළමයිගේ උත්තරය ගන්න මෙච්චර අද වෙන්නේ. Right. So next one. Manager for floor tile company estimated the demand for floor tiles is given by the following equation. P equal 300 minus half Q. Okay. Total cost equation is estimated to be TC 5060 Q squared. What is the number of flow tiles to be sold to maximize company's profits and the price of flow tiles at that quantity? How do you do this one? Simple mathematics. Huh? Simple
So we can
mathematics.
calculate this.
Yeah. Say. Yeah.
First, we can calculate the AC.
AC. Yeah. Why do you want the AC now? Office ke hot hai. Huh?
Average cost.
Yeah. Why do you want the average cost now? The question is, what is the number of flow tiles to be sold to maximize the company's profit? Profit maximization condition එක මොකක්ද? අයියෝ ළමයි මේ හැම question every question you see it as a new one නේ? We are doing the same thing again and again. It is differently asked. That's it. Concept එක one concept is we are using again and again.
MR equals NC.
Yes, MR is equal to NC. So how do we find MR? P is given, P into Q.
Delta TR divided by delta Q.
Yes, delta TR divided by delta Q. Yes. And TR. TR, what do we do? Yes. TC is given. We need TR to calculate the profit, right? So, we can calculate the MC, no? Isn't it? MC, how do we get? This is TC. I'm a question, like a malut question, neither.
Delta TC divided by DQ.
Yeah. So, not divider, we say like it is
Derive.
derive, yeah? Derivatives, yeah. So, derivative of cost.
Yeah, 60 plus Q.
Yes, 60 plus Q. That is the marginal cost, isn't it? Yes. So we can get marginal cost equal 60 plus Q, right? 2Q, ne?
2Q. Yes.
Yes. Marginal revenue. DTR divided by DQ, right? So derivative of the revenue with respect to Q. So revenue, so we put the TR is equal to P into Q, ne? P into Q. So P is given. Oh, it is given P, yes. P is given like this. You can see the Excel, no?
Yes, ma'am. Can see.
Yeah. So P is given like this. So into Q. So that is 300 Q minus half.
Half, yeah.
Yes. So profit maximization MR is equal to MC. So MC is MR is 300 Q. So 300 Q minus half equal 60 plus 2Q. So 298 there. So what the figure is coming? 298Q equal something wrong there. Like a half to something different. Half Q at the moment. Yeah, maybe doesn't matter. But as long as you're correct with the concept.
And so TR equal to 100 Q minus half. No. But it's, you have put the, for MR.
Sorry? TR, P into Q, no?
Yes. Yeah, there is TR, no. So, but we here, we have to put MR, no.
Yeah.
MR mean,
No,
what you
here it is
call
Q squared. That is the thing. Wait a minute. This is half Q squared, isn't it?
Yes, exactly.
Yes, ma'am.
Yes, then now correct.
Okay, so then that is this one. So where did I
So the
calculate?
MR comes 300 minus Q, ma'am.
MR is 300 minus. Yeah, that is also wrong. 300 minus half into Q squared means 2Q. So Q.
Yes, Q. 300 minus Q is the MR.
That's what. Okay, that's what. Generally don't get that kind of odd answers. Yeah, this is anyway minus 3Q. No, 3Q equal 300 minus 60, no? 240. Okay. Q equal 80. Right. Okay, so it is number of tiles to be sold, maximize the company's profit. So Q equal 80. Price of the floor tiles at that quantity. So here we put Q 80. So P equal 300 minus 40. That is 260. Okay, right. Okay. Quickly do this MCQ. Okay. Tell me the answer. Quick. Marginal product of labor. Again, no response. Okay, what is the answer? One say answer A. Another one is saying answer C. What is the correct answer? Just now also we dealt with marginal revenue, marginal cost, marginal revenue, additional revenue, marginal cost, additional cost. That should be the first thing. So marginal product, but in relation to something. What here it's marginal product in relation to labor. So it's always the product mean it is output. So additional output, right? In relation to additional labor. Yes. So answer is C. Why answer A? Additional labor required. So then it will be like marginal labor with respect to wage, maybe. Right? So this is about marginal product, means additional output. Marginal revenue mean additional revenue. Marginal cost mean additional cost. But it's always in reference to something. So marginal cost we talk in relation to output. When output changes, the cost is changing. How much the additional cost to produce additional 1 unit of output, right? So here it's marginal product of labor. So we are going to put more and more labor, output is going to increase. So labor is the independent, output is dependent. Output dependent on the labor. So how much of additional output we get when we put additional 1 labor? So additional output produced by hiring 1 more unit of labor. Why should you get confused with A and C? It is A, right? Okay, good. Okay, get the answer for these 3 questions. Like you send me one this thing, but first what, second what, third what. Okay. Three question, 3 minutes is too much. No answers. Huh? Why? First is D, A, B. D. A, B. Okay. First one is B. Another one is saying B, A, B. Okay. One is C. One C, one D out. One is, okay, following is a variable cost, right? So interest payment and property taxes, it doesn't change with the production level. Those are the actually the income for the fixed input. So if you have a building, so you will have to pay tax, right? Property tax or rent. Interest payments is whether the production is there or not, we will have to pay this one, right? Property is there. So I said, like the production, we know that at the beginning, we buy the, or we rent a building, right? Or we construct a building, or we rent a building, right? So whether production takes place or not, this month we have production or no, production is there or not, we still have to pay the rent. Similarly, the taxes. You can't tell the government, I don't have business this month, I can't pay the tax. No, I have to pay the tax. So it's not dependent on the production. So how come all of the above are variable? That's a wrong answer, right? So correct answer is B, isn't it? So you have to understand variable cost is related to production. If anything change, raw materials, yes. Labor also, because it is, if there is production only, there will be labor, right? So therefore, labor, raw material directly related to the production. So it vary with the production. Variable cost mean it varies with the production, right? Variable inputs vary with the production, and the cost incurred in those variable inputs is variable cost, right? So therefore, interest payments, property taxes, we will have to pay whether we have production or not. So therefore, they are not variable cost. Okay, right. Which of the following is an implicit cost? Explicit cost and implicit cost. That is something important in economic costing, right? Managerial decision making, we have to consider implicit cost, right? Implicit is what is not explicitly stated. Salary earned, it is, you have to say in your business, you have to show that it is an explicit item, right? Explicit cost. Depreciation value of a company owned car as it wears out, that is something implicit, right? In economic cost, we'll consider implicit cost. Whereas in accounting cost, we don't consider the implicit cost, right? So economic cost is always takes into account implicit cost, the opportunity cost basically, right? So the depreciation, it's something going into the implicit cost, right? Salary, property taxes, something we explicitly make that payment. It's very clear, right? Implicit is something hidden, not realized. Right? We realize, but it's not accounted, right? Explicitly. Okay, right. So therefore, second answer is also B. Okay, right. Third one. But did you all say? Yes, input is owned and used by a firm. Then it is, I use my own car, vehicle or the own property as my factory or the office, right? So I don't have to state anything explicitly. So explicit cost is 0. Implicit cost is 0 means it's a wrong answer. Why? This is implicit cost actually. Opportunity cost is implicit cost. Depreciation is implicit cost, right? So implicit cost is 0 means wrong answer. Opportunity cost is 0 means wrong answer. There is an opportunity cost. Economic cost is 0 means wrong. It is economic cost is implicit cost plus explicit cost, right? So what is the correct answer? Explicit cost is 0. Okay, right. Yeah. Do this one and post your answers. Today also I've been emphasizing this. You have to tell me the correct answer, at least first few correct answers. Okay, done? It is about output levels. If the output levels at which short-run marginal average cost curve reach a minimum are listed in the order from smallest to greatest. What is the smallest? And what is the highest? Yes, correct. Answer is C. Series. Yes, correct. So marginal cost, we know marginal cost takes minimum first. After that, average variable cost takes the minimum. Then the average cost takes the minimum, right? So in the order of the smallest to greatest. So ATC is high. AVC is smaller than ATC. And MC is smaller than even AVC. Okay. You remember those graphs. You should remember immediately the graph. You see here? See? MC is less here. AVC, this. AC, minimum, this. Isn't it? Right? So that is proved also here. Isn't it? Right? So this should make right. Short run marginal cost equal. A. Kelum says A. Marginal cost. Change in total cost divide by change in output. Yes, correct. Second one, change in total variable cost divide by change in output. Is it wrong? Huh? Series also says, yes, it includes fixed cost. Yeah, but fixed cost is fixed, no? So therefore, basically change in total cost equal to change in variable cost also. Isn't it? So second answer is also correct. B is also correct. Change in total variable cost divided by change in output. Why? Total cost is, within bracket you can put TC plus FC, but FC is constant. Take the FC out of the delta. So it is delta TVC divided by delta Q, isn't it? It specifically says short run marginal cost. So you should be alert. Short run marginal cost mean they are highlighting the fact that fixed cost is there. So take out the fixed cost so that if it is a long run, of course, only the answer, first one is the correct definition, isn't it? Change in the total cost divided by change in output. Whereas in the short run, even the B is correct. So obviously then D. What is the C? The cost per unit of variable input divided by the marginal product of the variable input. Cost per unit of variable input. That is variable input is labor, no? So that is cost divided by variable input is labor. So yeah, that is also correct. Marginal by the marginal product of the variable input. That is what I showed here, right? We had a graph like something like that. Relationship. So AVC we can write like this. W over APL. MC also we can write like W over MPL, right? So based on that, we can write that marginal cost is delta TC over delta Q, and the delta ABC. Instead of ABC, you can write APL and MPL, right? Right. So yeah. So the next one. Short run average variable cost. Yeah. What is the answer? Quick, you have to take 1 minute for this one. Short run average variable cost. Kelum says A. Anyone else? Average variable cost. Total variable cost divided by output. Okay, that is correct. What about the second one? Average total cost minus average fixed cost. That is also average variable cost now, isn't it? Moment you see one answer, you go for that, no? You have to, in MCQs, you have to read the other answers as well. Average total cost minus average fixed cost. What is that? Average variable cost, isn't it? The cost per unit of variable input divided by the average product of the variable input. Yes. Cost per unit of the variable input divided by the average product of the variable input. AP. All of the above, right? So, okay. Next one. Which of the following short run cost curve declines continuously? Okay. Very easy question. Tell me. Yes.
Average fixed cost. Still.
Yes. Average fixed cost. Yes. Correct. Balagi. Right. Next one. Yeah. So diminishing marginal returns begins at level of output. Where? What do you mean by law of diminishing returns? That is something, a law which tells that under the theory of production, the cost, the total product, right? So it is initially increasing at an increasing rate and then increases at a decreasing rate. And then it becomes constant. Then it is falling, right? You're giving two answers. A. Marginal cost is at minimum, average variable cost is at minimum, average fixed cost is at maximum. None of the above is correct. Its average variable cost is at minimum. Right. So where can you go for this? It's about diminishing, law of diminishing margin. You remember that 3 phases of production graph we had? Yeah. You remember this one? Right. So 3 stages actually. So first stage is up to point A. So then it is output is increasing, isn't it? Again, with increasing labor, but the rate of increase is decreasing. That is the diminishing returns, right? So then this second phase, this is the second phase. Third phase is actually the total product is falling, right? So if you take this second stage, what happens to your marginal product is decreasing. Average product is also decreasing. So if you convert this to cost, that marginal cost is minimum, right? And isn't it? So you remember this graph, and then opposite of this is this. There is a relationship, no, between the marginal cost and the average. Yeah, I think you can see here. See, your marginal product is already minimum. It has minimum here, and they intersect. Actually, when intersect, average product is maximum. When the average product is maximum, the marginal cost is minimum. So this is, sorry, average cost. This is average cost now. See, this is average cost. That is minimum, right? So in that, there is no such thing. Either because at this point, AP intersection, right? So AP intersection is in the second phase. AP falling. It happens actually even the AP maxima, right? So this phase is also like falling. Why? Marginal started falling, isn't it? So this phase, this duration, basically L1 to L3 is diminishing returns, right? You can see that somewhere else also. Here you can see, so this is that second phase, no? From this point, this A to C is the diminishing return points, or from A onwards, right? So A onwards mean your marginal product falls, right? And marginal cost, actually this is the point, marginal cost minima, right? But in your case, in the question, it says law of diminishing marginal returns begins at the level of output where marginal cost is minimum. No, it happens before that, right? So if it happens before that, mean definitely it won't, even the average variable cost is minimum, mean, because we know that average variable cost minimum after the marginal cost minimum, right? So therefore, diminishing return sets before the marginal cost become minimum. So therefore, these two are wrong, and the average cost is a maximum, that is also wrong. So the none of the above is the correct answer, isn't it? Anyone said that answer? No, nobody. Right. Look at the next one. Long run average cost curve is at minimum at level of output where? Tell me, this is easy. Previous one is a bit complicated, little, because it's about law of diminishing return. That is a law related to production, right? So you have to relate the production to the cost and get the answer. So that bit not straightforward, but the second question is straightforward. Yeah, somebody says D. Anyone else? I need at least 3 answers to go for the discussion. Yeah. Tell me the answer quickly. My God, why, man? Why can't you give the answer? This is something we have discussed. How many days now we are discussing this area, no? It is actually, you should give the answer like this, no? Answer D. Okay, 2 people have given answer D. Long run average cost is at minimum. Or somebody is giving answer C. Okay, long run average cost is at the minimum at level of output. Okay. Firm is experiencing constant returns to scale. Yes, correct, no? At the constant return to scale, average cost is minimum. Long run average cost is minimum. And it's equal to long run marginal cost. That is also correct, because marginal cost, we know the theory, marginal cost, whether it's a short run or long run, it will intersect the average cost in the minimum. So if the average cost minimum means that's equal to long run marginal cost. So the second point is also correct. Third is the long run average cost curve is tangent to the lowest point on the short run average total cost curve. Yes, when the long run average cost minimum mean, that is that flat part, that is constant return to scale, that area. During that area, we know that it will be tangent to the short run average total cost curve, right? So all of the above are correct, right? So you see that we had enough long run cost curve, no? Say this is constant return to scale. This is where the minimum comes, right? Long run average cost minimum will be during the phase of the constant return, right? So here it is higher, here it's again higher. So minimum will be in between this constant return to scale. And also you can see there is a short trend, this one, the tangent for that, no? Because it become horizontal to this and this. So therefore, whatever the short run average cost curve during that phase is tangent. The long run is tangent to the short run, right? And look at another graph here with the minimum. You see here, this is tangent to this short run cost curve, right? And this is the minimum, isn't it? All the other points it's above, higher, and this side all higher cost. Only during this constant return to scale, there is the average long run average cost curve is minimum, right? So that is the question, no? See, this is the minimum, right? So this is the constant return to scale. Right. So long run average cost curve is at minimum at the level of output where firm is experiencing constant return to scale, correct? It's equal to long run marginal cost, correct? And the long run average cost curve is tangent to the lowest point on the short run average total cost, right? All of the above occur, right? Get the answer for these three quick. 1203. Sorry, 103. I'll give you 3 minutes. What is the answer?
This one is DMAT.
What did you say?
First one is
First one is?
D. D.
D. Firm has downward sloping long run average cost curve. Downward sloping. The moment it says long run, this one you should remember the curve, right? We should see, look at this long run. This is downward, this is flat, this is upward. So the question is this downward sloping, isn't it? You say C. Moment you see the question, you should remember the right. So it is downward sloping long run average cost curve. Means it is experiencing decrease in return to scale. Is it the correct answer? No. It is actually experiencing increasing returns to scale. Decreasing returns is other side. It is the graph is upward. Downward slope, no, it's positively sloped. It's upward, right? So first and second one, it is experiencing decreasing returns. What is the difference between decreasing returns? It is a natural monopoly. Natural monopoly. Marginal cost is greater than the average cost. Marginal cost is greater than the average. No, that is also wrong answer. There is something wrong with this question. Natural monopoly means monopoly, downward sloping, long run
Madam,
average.
there is a curve. No, there is a curve. The long run average and marginal cost curve. Can you check that?
Which one? No, the question is about long run average cost curve, downward sloping long run average cost curve, right?
Downward. No?
Yes. What do you mean by downward? It is going downward, right? So I would think it is this phase that they're talking about, right? So if this continues, because that never continues, like whether it's a monopoly or the competitive market, it will be like either like this or else just you, right? It's either like this, right? 3-phase or 2-phase, right? So it is, this side is downward sloping and this is upward sloping, right? So the question is referring to downward sloping, right? And whether the marginal cost will be, no, monopoly, that is also wrong answer. It is experiencing decreasing return to scale, that is wrong. It's experiencing decreasing returns. It's about a long run now, so anyway it is returns to scale. So even I think there should have been one of the A or B, it should be increasing return to scale. There is some mistake in the question. So the correct answer is it is experiencing increasing return to scale. Okay. So downward sloping will be means the initial phase of the long run curve, right? So where we experiencing increasing return to scale. Decreasing return is the last phase of that, right? So that is decreasing return to scale, and there the cost is upward trend. It is increasing. During the first phase, the cost is coming down, right? So therefore increasing return to scale, right? So either we should correct the answer as B. B answer should be correct. It is experiencing increasing returns to scale, right? Okay. Marginal cost is greater than average cost. That is also wrong because marginal cost is below the average cost. So marginal cost is greater than average? No, there is no such situation. Marginal, so actually in this case, if they are referring to upward trend, here you can see this, in this case, actually the marginal cost, if you take the long run marginal cost, it will come like that and go through this one. So when it go through this one, marginal cost is above the average cost, right? So therefore it is referring to the upward side of the market, right? So the fourth answer is for the upward. So the question is about downward, right? So downward sloping long run cost curve is referring to economies of scale. And in this case, marginal is below the average, right? In this case, only marginal is above the average, right? So therefore, there is last answer is also correct or wrong, right? So marginal cost greater than average cost is, that will not happen during this downward sloping long run average cost phase, right? Okay. Next one. One reason that a firm may experience increasing returns to scale is that greater levels of output make it possible for a firm to, right, what are the reasons the companies are experiencing increasing return to scale that we discussed yesterday? D, all of the above are correct. Yes. Increase in return to scale, yes, they become specialized in machinery, and also they go for, because the scale of production is higher, so production level is higher. So they go for bulk purchasing and of raw materials so that they get discounts. That also happen. As a result, the cost per average cost per unit is coming down, and then employ a greater division of labor. Yes, the labors also can be divided. So that is there. Then all of the above are correct. Yes. D is the correct answer. Okay. Tell me the next one. One reason that a firm may experience a decreasing return to scale, that is that greater levels of output can result in greater division of labor. No, indivisibility. We can't divide the labor. That is the issue. We are experiencing decrease in return to scale, right? So yesterday I said, like, you're expanding your business, but you can't divide the labor and you can't manage the activities in various branches. So administration becomes difficult, right? So an increase in meetings and paperwork. Yes, that is a correct answer. So we do keep writing things everywhere, but still the production is not that efficient as it was earlier, right? So that one reason that a firm may experience decrease in return to scale is a greater division of labor. No. Increasing meetings and paperwork, correct. Smaller inventories per unit of output. No, inventories are also high. So that, because you are not able to manage your production, so you purchase this one inventories, but you can't do the production. So production is not properly coordinated. So as a result, you experience the long run cost is increasing after some time. Okay. So therefore, again, reason for decrease in return to scale. Wait, first one is wrong. So that definitely D won't be an answer. So the correct answer is B, an increase in meetings and paperwork. Okay, so that is what happened when you go beyond a certain level. Okay, right. So are you clear now about the these various costs and their behaviors and all? Any questions you have so far? Right. No questions? Are you okay with the area? You want any more questions or can we stop here?
Madam, the next session is new session.
Yes, it is 1:15. That's what I'm thinking. It is a new area. Right. There are a few more questions. So you don't respond. No, that is, it's kind of discouraging, disappointing me. Right. True or false quiz. Right. Okay. Tell me. At least few of you can talk, no, and give the answer, no, so that I can discuss, so that others will get benefit, no. You people are, everybody is keeping shut. It's very hard to proceed. Right. So tell me, what is the first one? The value of inputs owned and used by a firm is an explicit cost. Just now also we discussed. Is it true or false? Yes. Huh? Yes. PD says true. Others? Hmm? Yeah, we should finish it. Say.
False, no? It's a opportunity cost, no? It's a implicit cost.
Yeah, it's implicit. It's an explicit cost. Yes. The question is explicit cost. Yes, it is a false. I thought PDs is correct. Okay. It is an opportunity cost. It is, we don't explicitly state that. So therefore, it's not an explicit cost. Used by a firm is an explicit cost. So that is a false answer. False statement. Yes. Okay. Tell me the next one.
True.
Next
True.
one. Entrepreneur's opportunity cost is an implicit cost. Yes, it is true.
It is
Okay.
true.
And economic cost is generally lower than accounting cost. False, right? The reason, yeah, because in economic cost, we consider this implicit cost, the opportunity cost, right? So it is actually, whereas that is not counted in accounting cost. So therefore, economic cost is higher than the accounting cost. So therefore, that statement is false. Yeah. Next one. Accounting cost and explicit cost are the same. Question number 4. Put your question number and the answer, right? Hettige, it is for which question your answer is. B is for what? Which question? Yeah, 4B. 4 is what? Accounting cost and explicit cost. 4 is B.
Madam.
4 is true, no?
Excuse, madam, can you explain the third one again? Economic cost and the accounting cost?
Yeah, economic cost is including the implicit cost, right? Whereas accounting cost, it's just the explicit cost. Say, for example, salaries of people, raw material cost, and things like that, we explicitly state, right? Whereas this
that means-
opportunity cost part, yes.
Yeah, go ahead. Sorry.
Yeah, that opportunity cost part is implicit cost, which is not counted in accounting cost. So therefore, economic cost is generally higher than accounting cost.
Okay. Thanks.
So obviously, your line is not clear.
Fourth one is account costs false because the account cost mean implicit cost.
No, accounting cost is
True.
not implicit cost.
Account
It is
cost
explicit cost. Implicit is things like opportunity cost, right? So it is included in economic cost, right? So accounting cost are whatever explicitly stated, right? So therefore, fourth question is true. Okay. Fifth one, sunk cost. Sunk costs are not relevant to managerial decisions. True or false? Sunk cost is something we have already experienced, incurred, right? And what we need to know is for our managerial decision making, what's going to happen next. So, for our decision, what is the future cost, right? So the cost to be incurred, right? So therefore, sunk cost, it's gone, right? So it's the fortune, right? The foregone, right? So something we are foregone, right? So therefore, that is usually not considered in managerial decision making. Okay. So, say for example, right, something to be incurred. So we take the decision whether we continue with the project or not, right? So that is something a managerial decision, right? So for that, we'll say how much to be incurred. Based on that, we decide whether to go ahead with project or not, right? So that kind of cost, whatever foregone, is not considered for the managerial decision. So not relevant to this, true, yes. Okay. Look at this one. In the short run, total cost is equal to 0 when output is equal to 0. True or false? Hmm? You can talk. Yes, 1B. 1B. Okay. Correct. It's false because in the short run, there is something. Fixed cost is there.
Capital is fixed, no?
Yes, capital is fixed. Right. So that capital cost is there. So therefore, total cost is equal to 0. When the output is equal to 0, that's a false statement. Right. Okay. In the long run, total cost is equal to 0 when the output is equal to 0.
True.
True. Okay. Total variable cost is equal to short run total cost minus total fixed cost. What is the answer? Why such a long time for this question?
True.
True.
Yeah.
Okay, total variable cost is equal to Short run total cost minus total fixed cost. Yes, correct. Okay. Next one. Average fixed cost curve is U-shaped. Yes. False. Yes. Average fixed cost is not U-shaped. It's only the average total cost, right? So average fixed cost is always declining, going to infinity, right? So that is not U-shaped. It's always decreasing. Okay. Answer B. Right. Next one. Fifth one. Law of diminishing returns is reflected in the downward sloping portion of the short run marginal cost curve. Downward sloping. Marginal cost. Marginal cost initially decreasing and then increasing. Right. So the downward is initial part. Yes. Diminishing returns is reflected in the, yes, that's correct. Okay. True. Okay. Next one. Average total cost equal to marginal cost, where the marginal cost is at minimum. One A. This is where you people are making mistake. This is the way you read the question mostly. See, average total cost equal to marginal cost, right? When are they intersecting? I said marginal cost and average cost is intersecting minimum of not marginal, average cost. Read the question properly. Where marginal cost is at minimum. Marginal cost takes the minimum before average cost takes the minimum. So marginal is intersecting the average in the minimum of the average. Isn't it? You should remember that graph always. Just draw the graph and see what happens, right? And also it is proved. I showed you how it is. Marginal cost taking the minimum before average taking the minimum. Right? Then average variable cost takes the minimum. Then only average cost takes the minimum. Right? So therefore, marginal cost is intersecting the average variable cost in its minimum, and it's intersecting the average cost in its minimum. Right? Not the minimum of the marginal cost. So it's a false answer. Right? False statement. Okay. Next one. If the long run average cost curve slopes upward over some range of output, upward, then the firm is experiencing increasing return to scale. Yes, just now also we had a discussion, right? Upward means decrease in return to scale. Downward is increasing return to scale, right? So the statement is false. Yes. Next one. A point of inflection of the short run total variable cost function corresponds to the level of output where marginal cost is at the minimum. Inflection in the short run total variable cost function correspond to the level of output marginal cost is at the minimum. Total variable cost function is inflection. The marginal cost is at minimum. No, right? Marginal cost minimum means during that phase, marginal is below the average variable cost, right? So the point of inflection of short run total variable cost function corresponds to the level of output where the marginal cost minimum. No, right? It is false. Right? So next one. If marginal cost is greater than average total cost. Marginal cost greater than average total cost. Yes, that is after the intersection. Then average cost is rising. Yes, correct. It is true. Okay. And then fifth one, vertical distance between the short run average total and average variable cost curve is equal to marginal cost.
It's false, no?
False. It is fixed cost actually. The distance between the short run average total and the average variable is fixed. Fixed system makes the difference between those two. So it's a false statement. Yes. Yes. That's it. Right? So these MCQs are just to recall the theory. So everything you can actually remember to answer these MCQs, right? So it's simply, it helps you to make yourself clear with the concepts. Okay. Right. Any questions you have on the theory of production, theory of cost, long run, short run, variable inputs, fixed input, different cost, marginal cost, total variable cost, total fixed cost, average variable cost, average fixed cost, long run cost, short run cost, economics of scale, diseconomics of scale, law of diminishing marginal returns, marginal product, average product, total product. Very simple, isn't it? Right? Okay.
Yes, ma'am.
Yeah. So it's just a matter of absorbing the concept by yourself. Excel spreadsheet. Yeah. Okay. Okay, then. So with this, I'll finish this area. Okay.
Madam, please upload that.
Yeah. Today I'll upload. Yesterday I couldn't.
Moodle.
Yeah.
Possible that Excel sheet also.
Okay. I have put the previous one up to session 3. It's already there. Only the 4th one and 5th one.
Yeah, that is.
Sorry.
The previous one we already received. We download on that one.
Yeah. Right. Okay. So since actually I keep adding before the lecture, like depending on your, every time the students' response and all. So make it easy. So that's what I don't upload in advance. So discuss whatever and then upload, right? Okay, then see you all next week or week after next week. Probably I won't have the lecture because the other lecturer will take. Okay, then.
Thank you.
Thank you, madam.
Bye.
Thank you, madam.
Thank you, madam.
Thank you, madam.